Well, um, hello there. I want to welcome you once again to Mastering Accounting with F2 Angel. So today's video is based on a request and then mainly for finance students and also for people who wants to have a basic knowledge in accounting, people without previous background in accounting. So here we are going to prepare a revised financial statements, both income statements and the statement of financial position. And we will be looking at a question on Chips Limited, okay? And then there are few adjustments that will have to be made to the account. This account has already been prepared, but there are some errors and then adjustments that need to be done. So as part of our requirements, we are being required to prepare a revised set of financial statements, which is the income statement and the financial statement, the statement of financial position, pardon me. So in order for us to start, let us recopy the income statement that has been given to us, and then we can go into the additional information for the adjustments. So we'll be quick about it. And then our company is called Chips Limited. And then we are starting with income statements for the year ended. For the year ended 30th June 2016. Okay. We were asked that we should work in thousands. So the requirement says that we should work to the nearest £1,000. So we are going to work in 1,000. And then so we are going to work in 1,000. Okay, and then 1,000, right? So we'll start with our revenue figure. Revenue. Our revenue has been given as £1,850. So we are putting them into brackets because for the moment, we do not know whether there are additional informations that are going to affect the figures. So we are going to report them as we see. It's like copy and paste sort of thing. And then after revenue, we have cost of sales. And we should know the component that goes into cost of sales. We have our opening stock, purchases, and our closing stocks, sometimes carrying when at well. Okay. So here, the cost of sale figure they've given us is 1,040. So when we deduct cost of sales from revenue figure, we are going to arrive at gross profit. Okay, and gross profit, it's something that we have to calculate. So we are not going to have the 810 over here. And then we have operating expenses, expenses that we incur as a result of our operations. So operating expenses. And then beneath that, we have depreciation. We have been given a depreciation figure to be 220. In our previous video, we had explained what depreciation is and the various methods of calculating depreciation, okay? We have other operating costs. So these are costs that have not been given specific headings as far as the question is concerned. Okay, and then the other operating cost has been given as 375. So when we deduct our operating expenses from our gross profit, we are going to arrive at operating profit. So we have our operating profit. Sometimes it's being referred to as profit before interest and tax. And then our operating profit is also a calculated figure, so we will leave it at that. And then we have interest payable, the amount of interest that we have to pay on loans, okay? So interest payable has been given to us as 35,000. And then when we deduct our interest payable, we are going to arrive at a figure which should be termed as profit before taxation or profit before tax. Okay. So this figure too is also a calculated figure, so we will leave it at that. And then after that, we have taxation. And then our tax figure is a percentage of profit, which we do not know for now, so we leave it at that. So when we deduct our tax figure, we are going to arrive at the profit for the year. And profit for the year is also a figure that we need to calculate, so we'll leave it at that. Once we are done, then we are going to start with our statement of financial position. So CHIPS Limited. And then we have statements of financial position as at 30th June 2016. Okay. Right. So just as we did for the income statement, we'll also repeat same here. Remember to visit our previous video. It has explained, especially IAS 16, PPE, the part 1 aspect of it. We have explained a lot of terms that are so important to understanding the concept of IAS 16. So here, I'll just insert a new cell, okay? Right. So here we have costs, depreciation. In our previous video, we discussed the components of costs. And then we have, yeah, so that has been left like that. So we just bring our thousands. We're told that we should work in 1,000 pounds, okay? So now, beneath the assets, remember we have categories of assets, okay? We have non-current assets and then the current assets. The non-current assets and assets which have or which produce an economic benefit beyond 1 year. Okay, all these were explained in the previous video. So non-current assets. And then we have property, plant, and equipment. Remember IAS 16, property, plant, and equipment. And we had dealt with this so well that it should be something that we should be so much okay when we are working with it. So for Property, plant, and equipment, we'll leave the figures for now, just in case there are adjustments that we have to make. So we have buildings, and then we have plants and equipment. Plants and equipment. We have motor vehicle. Motor vehicle, right? So when we are done with our non-current assets, and then we can now calculate for our current assets. Current assets. We have inventories. So these ones, we have to bring the figures so that if there are any adjustments, we will just, post them to the accounts. We have trade receivable. Remember what we say about inventory, what we said about it. IS2, accounting for inventory. Trade receivables, we've been given it to be 420. We have cash at bank. Our cash figure is giving us 16, okay? When we are done, when we add both the non-current assets and current assets, we are going to get our total assets. So when we are done, we have to calculate for our equity and liabilities. These are the providers of funds, okay? So we have our equity figure. We'll start with equity first. And then within equity, we have been given ordinary shares fully paid. And this has been given as 800. We have reserves. Remember what we said about revaluation reserves, if you can remember during our previous video. So it's the treatment of the reserve was also discussed. So let's say reserves, okay? So this was given to us as 248. Profit for the year. The profit for the year is a figure that we have to calculate. So we don't have to post anything for now for the year. And then let's go to our non-current liabilities. Liability too has two components. We have the current and then the non-current liabilities. So non-current are those beyond 1 year and the current are those within 1 year period, okay? So it has the same understanding as the assets. So for non-current liabilities, we have borrowing, which is beyond 1 year period. This was given to us as 700. We do not know if there are adjustments that we have to make to each of the figures. So as it appears for now, let us post it. This is to help us save time, okay? To help us save time. So current liability, you have trade payable. Trade payable are amounts that we owe our creditors, those that we have taken items from on credit. So they are our trade payables, okay? And then receivables are those that we have sold goods to on credit. So receivable, monies that we are expecting to receive. Payable, monies that we are expected to pay. Monies that we are expected to pay. These are our payables and receivable money that we are expected to receive. So that's the difference. So other payables are payables for this question, those that does not fall within the trade payable, okay? And then we have taxation. Taxation too is a figure that has to be calculated. So for other payables, we have the first to be, for trade payable, it is 361. And then other payable has been given as 117. Okay. So now we will have our total equity and liabilities, or you can say liability, whichever. So now that we are done with this, let's go into our additional information to be able to do the adjustments. Okay, so the first one says that purchase invoice for goods received on 29 June 2016 amounting to £23,000 have been included. This means that the cost of sales figure in the income statements have been understated. Okay, our accounting period ends at 30th June. So whatever transaction that takes place on or before, we have to be included in our financial statement for that period. So we've seen that on 29, we had received goods, okay, we received a purchase invoice amounting to 23,000, but we had not included those things yet in our books. So now we have to reflect the £23,000 in the books. And remember, these are items that we are owing, we have to pay for them. But I told you earlier that the components of cost of sales are opening stock, purchases, and then closing inventory. Okay, so it means that it's going to affect our cost of sales figure. I said it has been understated, so we have to add 23 to remember we are working in thousands, so we add 23. And then when we come to payable, meaning that these are monies that we have to pay, they are trade payables. So we have to increase our payable figure by 23. And then note 2, a motor vehicle costing 8,000 with depreciation amounting to 5,000 was sold on 30th June 2016 for 2,000 paid by check. Once you say pay by check, meaning that we have received 2,000. So quickly, you go into your cash or bank figure to increase it by 2 because these are monies that we have received. Okay, so we'll come and add the 2 here. Now let's continue. So it's a step-by-step approach. So now this transaction has not been included in the company's records. So remember last week discussion on the part 2 aspect of IAS 16. We spoke about proceed on disposal. So in order for us to ascertain whether we have made a profit or a loss on disposal, it is important for us to know the carrying amount of the assets at the period of disposal so that we can know whether we have made profit or loss. Okay, so we start with our workings. So proceed. We sold the item for 2,000, right? And then let's calculate for the carrying amount of the asset. Remember what we said about carrying amounts, okay? How it should be calculated. So it is the cost minus accumulated depreciation. So let me bring this here. The item had a cost. The question says that it had a cost to be 8,000. So we have 8,000 here. And then with depreciation amounting to £5,000. So depreciation, it's equal to £5,000, meaning that our carrying amount now, or the net book value, carrying amount, the amount that we carry, okay, the item for in our books. So this will be equal to, we will subtract the depreciation from the cost of the assets. So it means that the carrying amount at the time of disposal was 3,000. So in order for us to ascertain a proceed, a profit or a loss on disposal, means that we have to compare the 2,000 to the 3,000 on disposal. And this will give us, which is equal to, that will be the 2,000, but this is how much we sold it for. And then the 3,000 is how much it was worth in our books. This gave us a negative 1,000. So in this question, it is not a profit, it's rather a loss. And when it's a loss, we have to include that value in our income statement. So we have incurred loss of 1,000. So this will affect other operating costs. So there are other operating costs that we have incurred. Instead of profit, we have made a loss. So we have to reflect it. Okay? So let's proceed. So, and then, okay, so the question does not end there. Okay? So let's come back to motor vehicle. Our workings on motor vehicle have not yet been concluded. So now, remember at the beginning of the year, at the end of the year, we had reported motor vehicle to be 102. And then our depreciation was 153. But now we have sold a motor vehicle that was worth 8,000. Remember, we said something about derecognition in our previous video. So we have to derecognize this particular motor vehicle from our books. Okay? So we have the total cost on motor vehicle to be 102. Okay? So this gave us 102. And then remember, the one that we had disposal cost us 8,000. So we'll just say 8 because of the figure that we've taken from the statement of financial position. So this will give us 102 minus 8. Remember, we've sold it, so we have to take it off. And then when we come to depreciation here initially had given us, it had given us 53, okay? It had given us 53, and we're told that the motor vehicle that we sold had a depreciation worth 5,000. So we take out the 5, and then when we do that, so it will be 53 minus 5. This will give us 48. Okay, so at the moment, this is the value of our motor vehicle on account. So let's proceed. So we were told that no depreciation on motor vehicle has been charged. The annual rate is 20% on the cost of the assets at the end of the year. So now, for the current year, we have not charged depreciation, okay? And then the current depreciation now, it will be based on the remaining motor vehicle that we have. Okay, so the remaining motor vehicle is what depreciation will be charged on. So our current year depreciation, we were told that it is 20%, okay? So this will give us 20% is the same as 0.2. So 0.2 multiplied by 94, that is the current cost of the asset. This will be 18.8. Remember, we are working into one decimal places, so we are working with the whole figure, okay? We are not working in decimals. So instead of 18.8, we are going to report it as 19, okay? So now, Okay. So we'll go to our depreciation figure in the income statement. And then we will come and charge that additional depreciation, the current year depreciation. And remember, it's also going to affect the initial depreciation that we had charged. Okay. So we had deducted the 5, and then we also have to add the 19. That's a current year depreciation to be able to ascertain. Just a minute, let's do that again. So yeah, so we deducted the 5,000 that was on the disposed assets, and then we add the current year depreciation. That will give us 67. Okay. So now let's proceed. So a sale on credit for 16,000 made on 1st July 2016 has been included in the financial statement in error. The cost of sale figure is correct in respect of this item. So what they are saying is that, our accounting period ends as at 30th June. So it is when a transaction that occurs or that has occurred on or before 30th June that should be included in our books. But mistakenly, we had included a transaction that had occurred on 1st July 2016, which should affect the subsequent year financial statement, not the reporting year financial statement. Okay. So it means that our sales figure has been overstated. So if it has been overstated, we have to deduct that 16,000 from the figure. So let's do that. So sales or revenue is the same thing, okay? So we have to subtract the 16 from here. And then let's go back to the question. The question is saying that it is a credit sales. If it's a credit sales, it means that we sold the goods on credit. And then when we sell the goods on credit, our receivable figure would have increased. And because it had increased in error, we have to take it out. So receivable can be found in current assets, okay? So we will come and deduct that 16 from receivable amount that we are expected to receive. So these are receivable. We'll come and make the adjustments. Okay, so we're told that the cost of sale figure is correct, which means that there will be no adjustment made to the cost of sale figure. A half-yearly payment of interest on the secure loan due on 30th June has been paid. It means that we had paid half of the loan, okay? And then half of the interest on the loan. So when you check our income statement here, the interest payable figure here is 35. So it means that if it is half, you multiply this by 2, giving you 70. If it is 40, multiply by 2, giving you 80. It means that we have paid for half, and then we still have another half to pay. Okay, so these are payable that we will still need to pay. Okay, so it means that, we said something about current liabilities due within 1 year. So it means that the other half of the interest payment will have to be paid in the following year. So which now become a liability to us, our financial obligation. So we will come and increase our other payable by the remaining half of 35. Okay, so let's proceed. And then the tax charge should be 30% of the reported profits before taxation, assuming that tax is payable in full shortly after the year, meaning that we have paid tax for the year. Okay, so remember we had included taxation here. We have to take it out. It has been paid, so it's no more a liability. Okay, and then I forgot to address one thing. We said that we had purchase invoice for, okay, I think I've taken care of that already. I've taken care of it. Okay, that's fine. So, meaning we are done with all the adjustments. So far, we are done. So those that we didn't pick the figures, let's do that now so that we can balance the account. So building here had a cost of 800, depreciation to be 112, and then we have the carrying amount or the net book value to be 688. Plants and equipment had a cost to be 650, and then depreciation to be 367. We had the net book value to be 283, carrying amount or carrying value. Motor vehicle has a revised cost now. So we will just go to our workings. So the new cost for motor vehicle is now 94, right? The working that we did initially. So it's now 94. And then our accumulated depreciation now is now 67. So 67 here. So, sorry, 67 here. When you do the subtraction, 94 minus 67, this will give you 27, okay? So we are done. Now we have to calculate for our total non-current asset. So when we add the 3, the building plus plant and equipment plus motor vehicle, this will give us 998. So inventory wasn't affected, so inventory will still be worth 95. But for trade receivable, we had overstated it by 16, so we have to take that out. So 420 minus 16, that will give us 404. And then cash at bank, remember, we have sold motor vehicles, so our cash figure had increased by 2. Now our cash at bank has increased to 18. So our total assets now, so let's calculate first of all our total current assets. So this will give us a 950 plus 404 plus 18, giving us a total of 1,372. So our total assets now, will be our current asset plus our non-current assets. So our non-current asset figure is 998 plus our current asset figure to be 1372, giving us a total of 2,370. Okay, right. So now let's go to our equity figure. Our ordinary share capital was giving us 800, there was no adjustment. And then reserves to remain at 248. Now let's calculate our profits for the year. Okay, we haven't reported that, so let's leave that for now. We will go back. So our borrowing for the period still remain at 700. And then trade payable. Remember our trade payable that wasn't recorded was 23. So we have to add it to that, how much we are expected to pay. That will give us 384. And our other payable that we had was 117. We're told that we still have some interest to pay. So this will give us 117 plus 35, giving us 152. So our total equity in line, let's hold on for now because we haven't gotten the profit figure yet. So here for revenue, we were told that we overstated revenue by 16. So we have to take that out. So it will be 1850 minus 16, giving us 1844. And then our cost of sales figure 2 was also understated by 23. So it will be 1040, 1040 plus 23. This will give us 1063. So gross profits now, it is the revenue figure minus our cost of sale figure. This will give us 781. Okay. So now depreciation, remember we have made some adjustment to depreciation. Our current year depreciation on motor vehicle was added. So 220 plus the 19, this will give us 239. Remember, we had incurred loss on disposal of the motor vehicle. Okay, so 375 minus 1, giving us 374. So in order to get our operating profits, we will have to subtract. Okay, let's do this. Let me report these two figures here, so that when we are summing it up, it won't be difficult. Okay. Right. So operating, so now we have to get the total operating expense. So this will give us the total depreciation plus other operating costs, giving us 613. So when we subtract, so operating profit, it is a gross profit minus operating expenses, okay? So we were given our gross profit now is 781. And then we will subtract the total operating expense of 613 from that. And then we will arrive at 168. Okay. So yeah, 168. So this now become our operating profits. So interest payable has been given as 35. So when we subtract that, so this will be the 168 minus the 35, giving us 133, So tax is calculated. We're given an instruction that tax is let's see, 30% on profits before taxation. So 30%, so that will give us it's the same as 0.3. So 0.3 multiplied by the profit before taxation, giving us 39. Right, so let's watch and see whether we had reported everything. Okay, so yeah, that gave us that. So our profit for the year gave us profit before tax minus the current year taxation, giving us 93. Okay. So let's see. Let's see this. Let's recalculate our depreciation again. So to give us 220 plus 19, 239. Okay. So this here plus this, giving us this. So let's check this out. Okay, so let's see this. 1850 minus 1850 minus 16 or 6. Sorry, it was a typo that's I actually did. So as okay, minus 16. So this now is 771. And then our operating profits, the same as profit before interest and tax, will become our gross profit minus our operating expenses, giving us 158. And then our interest payment is 35. And then profit before taxation will be equal to our operating profit minus our interest payable, giving us 123. So tax now is calculated. We're given that tax is 30%, right? It's the same as 0.3 multiplied by the profit before taxation, which is 123. So this will give us 36.9. Remember, we are working with the whole figure. So we'll just type that to be 37. Okay. So let's show the workings here. 0.3 multiplied by 123, 123. So it means our profit for the year now stands at 86. Okay, it stands at 86. Okay, so now we will then now have to report the profits for the year figure, which is giving us as 86. Okay, so when we do that, we can now calculate for our total equity and liability. The total equity figure now becomes 800 plus 248 plus 86, giving us 1,134. And then our total liability figure now will be giving us our non-current liability plus our current liabilities. So the total equity and liability figure now becomes the 1,134 plus the 1,236, giving us 2,370. So let's see if we have balanced our accounts. Yes, our account has been balanced. So this is how we go about adjustments, okay? For the sake of this question, these are the various adjustments that we needed to do. And we have done so. And by so doing, our account has balance. So you can take your time and also see if you can redo the question. And if you have any question that you want to ask, kindly feel free to ask your question. Thank you so much for the time, and kindly remember to like the video, subscribe, share, and also hit the notification bell so that whenever new videos are uploaded, you will be the first to be informed. Thank you so much, and I appreciate the time spent. Mastering Accounting with FT Angel remains the name of the channel. Thank you and bye bye.